Welcome back. You're watching Halftime Report, shifting focus to the oil and gas sector now. Dayanand Mittal, the oil and gas telecom research analyst at JM Financial Institutional Securities, now joins us from the sidelines of the JM Financial India Conference 2024. Dayanand, good afternoon. Thank you so much for joining in. You know, the recent developments surrounding these city gas distributors with yet another cut to their allocation on the APM gas. What do you make of this, and do you believe that is there enough for these companies to cover up from the potential losses that will come in from this cut in allocation yet again?
Yeah, good afternoon. Thanks for having me. This is a big shock for all these CNG dominated CGD companies like IGL, MGL. The current gap versus petrol for CNG is about 40-45% in terms of cost per kilometer, rupees per kilometer basis. So there is scope for them to take price hikes. Our sense is they might be forced to pass on the large part of this increase in gas cost to end consumers, somewhere between 6 to 8 rupee, if not immediately, maybe gradually over the next few months. Otherwise, there will be a sharp hit to their margins. But as a result, the cost competitiveness of CNG might moderate sharply from 40-45% currently, and from peak of 60% plus 2-3 years back, to more like 35% versus petrol. Versus diesel, it will drop sharply from 20% to more like 15%. So this will definitely have some moderating impact on volume growth from a more medium to long term. Near term may not be much, but from medium to long term, this will moderate volume growth. And this will be a structural issue given the APM allocation will keep on declining every year by 5-7%. Given all this APM gas will get reallocated as new well gas, which would be about 20-25% expensive versus APM. So this will be kind of a perpetual issue for the CGD companies over the next few years.
So a two-part question then, Dayanand. One, I wanted to know if you've done any sort of sensitivity analysis on, how much of a price increase impacts the volume and margins of these companies. And the second part, now since you're saying this will be a issue which will continue for these companies, do you think there is case for structural derating of the multiple that you give to them? If yes, then what should then the new normal be?
Yeah, so obviously, as we discussed, the competitiveness versus petrol will moderate from 45% currently to more like 35% versus diesel from 20% to 15%. Difficult to put a number, but empirical studies suggest versus diesel, you need at least 15% plus, ideally 25% for customers to get incentivized to convert to CNG, and versus petrol at least 30-35%. So now this differential is at the lower end of that range. So though existing customers who have switched to CNG, for them it's a sunk cost, so they will keep on using CNG, as CNG is still economical versus petrol diesel, but new customers will be now under doubt, a bit hesitant, and hence volume growth that we used to see for these CGD companies, let's say terminal volume growth of 4-5% for IGL, MGL, may get moderated by a couple of percentage points, so more like 2-3%. Difficult to put a number, but yeah, there would be definitely some moderating impact in terms of volume growth going forward. In terms of derating, yes, it's a big derating event, more than earning cut, given they can pass on most of this to end consumers. So earning cut may be limited at 10-15%, but the biggest challenge is the derating event, because this raises question on whether government's favorable policy stance towards CNG business, given it's more environmental friendly, whether there's a U-turn there or not. So there's a lot of doubts now as to what led to this sudden U-turn in government policies. Also, given there are a lot of press report quoting government sources that government will look into all the CGD companies' cost structure to decide how much of CNG price hike they should take, given they make significantly higher profit in the past. So that also raises question marks on what the government intent here is.
So how much should the multiples derate by according to you? And how much have you taken?
Yeah. So we value it on a DCF basis. So the implied multiple for IGL, MGL, for IGL would have gone down for us from more like 17-18 times, let's say FY27 earnings, to more like 12-13 times now. Similarly for MGL, from 15 times to more like 10-11 times now. So almost a 30-40% derating that we've seen in our target multiples.
All right, Dayanand, we'll leave it at that. Thank you so much for sparing time and joining us with your views on these city gas distributors, a big derating event coming in for these companies. Time for a short break. More on the markets and specific stocks on the other side. Stay tuned.